Hey everybody, welcome to Mortgage Today for Thursday, August 17, 2023, and oh, what a day it was. This morning, MBS seemed to be saying that it wanted to stay in this new low range on the charts. Bonds were down 19 basis points very early, stocks up 7.42 points. Bonds were moderately weaker in the overnight session, with 10-year yields up as high as 4.312. In Asia, before recovering in European hours, they were just under 4.3 to start the U.S. session and have traded near that through most of the morning. Jobless claims came in at 239,000 on a 240 forecast, which is still a pretty strong number, 248,000 previously. Philly Fed came in at 12 versus a negative 10 forecast. It was negative 13.5. Prices paid was at 20.8 versus 10.1 forecast. It was 9.5 previously. People keep buying stuff. More problems out of China. Rare protests have emerged as one of the largest asset managers has missed about a dozen debt payments. We also got Fed minutes yesterday that showed that both the staff and the participants characterized economic growth as moderate, which seems about right. A couple of voting members favored maintaining rates but did not dissent. Interestingly, the latest Atlanta Fed GDP Now forecast has Q3 GDP coming in at 5.8% based on yesterday's housing starts and industrial production numbers. We need to be very aware that right now we are in a trend of rising rates and that it can possibly get worse and likely will. In 2023 Q2, total household debt was $17.6 trillion, up trivially from $17.05 trillion in the first quarter, compared to 2019 quarter four when it was $14.16 trillion. Debt has risen $2.9 trillion, which is 21.3%. While that seems substantial, inflation between that time was 17.6%, meaning that inflation-adjusted debt is up about 0.4 trillion. What changed? Household debt now comprises 70.7% of debt, up from 67.7% in quarter four of 2019, while student debt is down from 10.7% to 9.2%. There comes a time in a protracted bond market selling sprees where the momentum takes a glacial quality. Intraday volatility may pay some heed to discrete big-ticket events, but the rest of the day is spent moving steadily toward higher yields in a mindless and disconnected way. The past week and a half has been a perfect example, and today is no exception. Yields were actually at the lows on the day an hour after the AM data, so we can't really blame it for the sell-off that took tens to the brink of the highest levels since 2007, or mortgage rates to the highest levels in more than 20 years. At the end of the day, MBS were down 5 basis points. Stocks lost 34 points. So closing the day at 97.69, we are just narrowly even on any kind of line, Fibonacci retracement line, any kind of technical on that 5.5 chart. So might have to start looking at the 6%. We also got news that the average independent mortgage banker lost only $534 per loan in the second quarter. So still losing money. $534 per loan losses is not good, but it's a big improvement from from losing $2,000 per loan previously. We also got a post from our sponsor at WellThatMakesSense.com. So this is all about amplifying your influence. This is from the great book by Renee Rodriguez. So this is about the tie down, where the value is created with a clear influence objective in mind. So this is all about triggering oxytocin to be able to influence people. So check it out on our sponsor at WellThatMakesSense.com.